watching ET Insight. Now, the economic crisis in the Eurozone is spreading like wildfire. It's affecting everything from the financial sector to sovereign ratings. Now, should any bank or other financial institution fail or default, that's going to have a domino effect. So is a Lehman-like crisis therefore inevitable? I caught up earlier with Jan Randolph, head of sovereign risk at IHS Global Insight, and I asked him just that.
Well, there's several reasons for believing there won't be the equivalent. Lehman Brothers were an investment bank at the centre of an investment banking world, and there's no real equivalent in terms of European banks here. The counterparties are better known, particularly those who hold the sovereign debt. I think the other reason why we wouldn't expect a Lehman Brothers-like scenario is because the capital flows portfolio has already flown because of the drawn-out nature of the crisis. So it's unlikely to be cataclysmic shock like Lehman Brothers was.
But there are various estimates on just how much money banks in Europe need to avoid a 2008-like crisis. To your mind, what is actually a realistic figure?
Well, any figure has to relate back to what essential markdown one estimates or judges for that sovereign debt, peripheral sovereign debt, is actually going to be indefinite. In other words, that will endure through the crisis and beyond. And there's various estimates for that. I think what needs to happen is that the markdowns need to be ahead of the worst case scenario the markets are currently estimating. 60% for Greece, 40% for Portugal and Ireland, 20% for Italy and Spain. And that comes to around about 200 billion euros.
But where is that money going to come from now? Germany, the IMF, or the World Bank, do you think?
It's a good question. Essentially, it's in terms of recapitalizing the banks, the Germans have already laid out the process that the first source of money will be the banks themselves, trying to get it from the markets. If they can't get it from markets, the second line of second source would be the national level. It may be a state-owned bad bank or a sovereign wealth fund in the case of France, providing the public funds. And there's a third and final line of defence, if you like, or source of capital raising, which is the EFSF itself. And that represents a contingent liability, half of it from German taxpayers.
So why is there no consensus then emerging between European leaders on resolving the economic crisis? I mean, do you think the big economies like Germany and France are really doing enough, since there is no detailed plan as yet?
I think you can see a number of lines of tension here. One obvious one is the net creditor versus the net debtor. To what extent the largest net creditors, Germany obviously being the most important in that group, would want to sort of like extend their liabilities to others. That's one source of tension. The other one is between Germany and France itself, particularly over the actual exposures of their banks to southern Eurozone government and bank debt. The French have more than the Germans, and we've seen a tension there about access to the EFSF funds for recapitalisation precisely on that tension. There's also a third tension, which is more general in terms of like how they're going to approach the overall resolution of sovereign debt. Where again it goes back to the role of the ECB and the EFSF, as well as the borrowing countries themselves and what burden they should be sharing.
And what about the European Central Bank? Has it done enough to contain the crisis?
I personally don't think so. I think it's one of the sources of uncertainty and risk averseness in the European markets. The European Central Bank has a distance from its governments in the same way that the Bundesbank had kept a distance from the government of Germany. But in a sense, that's created problems in terms of crisis management, precisely that distance and independence. In a crisis situation, they should actually come together to try and resolve the crisis. Yes, I don't think it's done enough. It's got to rise up as a continental bank for a Eurozone and be lender of last resort in all markets, not just a few.
Now, there's still a lot of pressure, Jan, on Greece to cut expenditure before it gets any further bailout money. I mean, how do you see the debt crisis in Greece panning out now? Well,
I think we're sort of preparing ourselves for a deeper haircut, a rescheduling of Greek government debt. Berlin has taken note that we need growth in Greece. The debt has to be sustainable, but the burden will be on the private bondholders, and that means essentially principal holidays for several years in the near term, probably thrown onto the back end years. I mean, that is an implicit loss or haircut for the private sector banks holding Greek government debt, but it's necessary in order to allow Greece to grow again, and that's absolutely key.
Now, there are some people asking for an orderly default of Greek loans. Is that a good idea, do you think? And if yes, how must it be carried out?
Well, the default means that Greece can't meet its liabilities as it's signed into, the financial liabilities, and a rescheduling of those liabilities is absolutely necessary. Again, it will revolve around the near years principle, basically a holiday taken for year 1, 2, 3 and 4, and the principle thrown into the future. That will allow the economy to breathe again. Now, technically, that's a default. It is also a net present value loss on the assets that these banks have with respect to Greece.
But I mean, is the EFSF system really enough to deal with this crisis, do you think? France wants to tap the Eurozone's 440 billion euro European financial stability facility for recapitalisation of banks, while Berlin is insisting that the fund should be a last resort.
Well, there are a number of questions about the EFSF fund. It's a baby mini IMF, now going to get new powers, recapitalising banks, providing contingency lines of credit. But yes, Germany sees that very much as the last resort fund. The level of responsibilities here lie first and foremost with governments and their fiscal situation, and Germany want to keep the pressure up on that, on the borrowing countries, particularly in a bailout situation. And then when it comes to bank recapitalisation, they've made it clear that it's the onus is on the bank first, then the national government, and then finally the bailout fund, the EFSF, and that's the order of responsibility, and that's the order of support that will happen.
So is the system really then enough to deal with the crisis?
It's a difficult one. If you look at bank recapitalisation, there seems to be enough money available purely in the EFSF, but that's the third line of support. If you include what could be raised from markets, what could be raised from state-owned bad banks, there should be enough money on that respect. But we are also talking about the weaker sovereigns. They will have to go through. They will have to follow through with a one-off fiscal adjustment in order to stabilise their debt dynamics.
Now, Moody's recently downgraded Italy's credit rating and also cut rating for some of the UK's banks. Could the debt contagion still spread to other economies like Spain and Italy?
Well, we've already seen the contagion. Greece's risk by itself is quite small and should not necessarily be a problem. But we've seen how risk in Greece has amplified risks throughout the system, not just the banking system, but also to Spanish and Italian borrowing costs that have shot up. That is a direct response to the way in which they've dealt with the Greek situation so far. So, yes, we're already experiencing the contagion, but part of the overall resolution is not simply just bank recapitalisation to show the markets, to snap the psychology that they have more than enough capital to deal with the worst case scenario when it comes to sovereign bonds and markdowns there. But it's also making sure that Italy and Spain in future are able to control their own finances, and that's why there's been still rating downgrades for Italy. It's simply the case that the Berlusconi government's run out of political capital in terms of being able to carry the country through a period of austerity and reform.
I suppose ultimately, Anne, I mean, do you really see the Eurozone breaking up?
Well, it's incumbent on all those people who talk about meltdown and breakup, how that actually pans out in reality, outside their imaginations. At the end of the day, to leave the Eurozone and to join the Eurozone is a political question, and one has to point to the politics of leaving as well as the politics of joining, whatever the macroeconomists and risk analysts are saying. So, at the end of the day, the costs of a fracture is a lot greater than actually currently dealing with the situation through the use, for example, of the EFSF.
With that, it's a wrap of this edition of ET Insight. Please do send us all your suggestions and feedback. Many thanks for watching.